Chapter 5, Learning Objective 3. Analyze and record sales transactions for a merchandiser. In addition to purchases on account, a merchandising company's operating cycle includes the sale of merchandise inventory on account or on credit. The sale of merchandise inventory is recorded with two entries. The first entry includes recording the sale by debiting cash or accounts receivable and crediting sales. The second entry involves recording the cost of the sale by debiting cost of goods sold and crediting merchandise inventory. This second entry is how we employ the matching principle to match the cost of the car against the sale. Let's assume the vehicle purchased by Excel is sold for $4,000 on account, and recall from Learning Objective 2 that the cost of the vehicle in Excel's merchandise inventory account is $2,798. Our sales entry includes a debit or increase of $4,000 to accounts receivable and a credit or increase to sales of $4,000. Now we must match the cost of goods sold against the revenue and remove the vehicle from inventory with a debit or increase to cost of goods sold and a decrease or credit to merchandise inventory, both for the final cost of the car of $2,798. So once again, the first entry records the sales revenue and the second entry is required to reduce the merchandise inventory account and transfer the cost of the inventory sold to cost of goods sold. This also ensures that both the merchandise inventory account and cost of goods sold accounts are up to date. Now let's talk about sales returns and allowances. When merchandise inventory that's been sold is returned back to the merchandiser by the customer, a sales return and allowance is recorded. For example, assume some damage occurs to the merchandise inventory sold by Excel while it's being delivered to the customer. Excel gives the customer a sales allowance by agreeing to reduce the amount owing by $100. We record this allowance with an increase or debit to a sales returns and allowances account for $100 and a credit or decrease to accounts receivable for $100. Accounts receivable is credited because the original sale was made on account and has not yet been paid, and now the amount owing for the customer is reduced to $3,900. Another important note is that the sales return and allowances account is what we call a contra revenue account and is deducted from the sales when preparing the income statement. This treatment is similar to how the accumulated depreciation contra asset account is deducted or netted against its related asset account. If goods are returned by a customer, a sales return occurs. The related sales and cost of goods sold recorded on the income statement are reversed, and the goods are returned to inventory. For example, assume Max Corporation sells a plastic container for $3 that it purchased for $1. We would have a sales entry that includes a debit to accounts receivable and a credit to sales of $3 to increase both accounts. Then we match the cost of the sale with a debit to cost of goods sold and a credit to merchandise inventory for $1. If the customer returns the container and the merchandise is restored to inventory, the dual journal entry would essentially be almost a complete mirror image or reversal of the original entries, starting with a debit to the returns and allowances account and a credit or decrease to accounts receivable, followed by a debit to merchandise inventory of $1 to put the item back into inventory, and a credit or decrease to cost of goods sold. Now look at these entries closely. Can you spot where these entries are not an exact mirror image reversal of the original entries? If you pointed out the debit to the sales, returns, and allowances account, you'd be right. Note here that we're not debiting the sales account to reduce the sales, but we are increasing the sales, returns, and allowance contra account, which has the effect of resulting in a lower net sales amount. We do this because we want to see our total sales before any sales returns and allowances, and then to separate our returns and allowances to help us monitor and manage them better. Essentially, the use of a contra account to record sales, returns, and allowances permits management to track the amount of returned and damaged items. Companies often offer sales discounts, which would be the equivalent to a purchase discount received by the purchaser. To better track sales discounts, we use a contra revenue account in the same way we do for sales returns and allowances. A sales discount records reductions in sales amounts when a customer pays within a certain time period. So for example, let's assume Excel Cars Corporation offers sales terms of 2/10 and 30, where the amount owed must be paid by the customer within 30 days. Remember, N equals net, or net 30. However, if the customer chooses to pay within 10 days, a 2% discount may be deducted from the amount owing. Consider the sale of the vehicle for $3,900, which was the original $4,000 less the $100 allowance for damage. Payment within 10 days entitles the customer to a $78 discount, calculated as $3,900 times 2%. If the payment is made within the discount period, Excel receives $3,822 in cash, that's $3,900 minus a $78 discount, and prepares this entry. A debit to cash of $3,822, a debit or increase to the sales discounts contra account for $78, and a credit or decrease to accounts receivable for $3,900. This entry reduces the accounts receivable amount to zero, which is the desired result. If payment is not made within the discount period, then the customer pays the full amount owing of $3,900. The balance in the sales discount account is deducted from sales on the income statement to arrive at net sales. Merchandisers often report only the net sales amount on the income statement. Separate general ledger accounts for each of the sales returns and allowances and sales discounts are useful in helping management identify potential problems that require investigation. If we don't separate them and just bury them into the sales account, we can't tell how much we're giving up by offering discounts or if the value of our returns is high.